You work hard for your money, and you've built some serious wealth. But what if you could keep more of it? For most people, taxes are just an annoying cost, but for millionaires, the tax code is a toolkit, a set of powerful rules designed to help them build their wealth. And this isn't just about cheating the system. I mean, it's about using it wisely. It's about being proactive and making smart decisions to minimize how much you lose to taxes every year. In this video, we're going to dive into 5 of the most powerful strategies that high net worth people use, giving you a blueprint for turning taxes from a liability into a major advantage. Just real quick, my name is Ryan, and I'm a CPA, and please give this video a like if you find it helpful. For high income earners, maxing out your 401k is a great first step, but it's really just the beginning of what's possible. A lot of people can't even contribute to a regular Roth IRA because of income restrictions. If you make too much money, you can't contribute to a Roth. As simple as that. Those limits mean that you need a much smarter and more creative approach to saving for retirement. And that's why we have the backdoor and mega backdoor Roth IRAs. Okay, so let's talk about the backdoor Roth IRA. It's a totally legal hack that lets high income earners contribute to a Roth, even with those pesky income restrictions. The strategy is pretty simple. You make a non-deductible contribution to your traditional IRA. Then you immediately convert those funds into a Roth IRA. The reason this works is that the IRS doesn't just put an income limit on Roth conversions. So it's a perfectly legal way for high earners to get that sweet tax-free growth. But an even more powerful strategy is the mega backdoor Roth. This isn't a specific account. It's a strategy that uses a few special features in your employer's 401k plan. The whole thing hinges on a unique combination of tax code provisions that lets you contribute way more than the standard limits. In 2025, for example, the normal limit is $23,500 of contributions for the year, with an extra $7,500 for those who are 50 and older, and a new catch-up contribution limit of up to $11,250 for those aged between 60 and 63. Now, the mega backdoor Roth strategy takes advantage of a separate, much higher overall limit for total 401k contributions, which in 2025 is $70,000, or up to $81,250 for those, between 60 and 63 years old. Here's how it works. First, you max out your normal employee contribution to your 401k, either pre-tax or as a Roth contribution. Next, you make an additional after-tax contributions all the way up to the total IRS limits, minus any match that the employer gives you. And then finally, you do an in-service distribution or conversion. And that is what that means is you roll all the after-tax money into a Roth IRA or Roth 401k. And because they're after-tax contributions, that event of converting it will not be taxable. This process turns money that would have just grown in a regular after-tax account into a Roth account, where all the future growth is completely tax-free. The existence of these strategies shows a key point. Your tax planning potential isn't just about how much you can earn, it's also tied to your employer's benefit package. The mega backdoor Roth especially requires your employer's plan to allow both after-tax contributions and in-service distributions. And not all plans can do that, so make sure before you even plan on doing this, check with your employer and your 401k provider to make sure it's doable. Another powerful retirement tool that people don't really think about is the HSA account, the health savings accounts. That was kind of redundant. So most people see health savings account as a way to pay for medical bills. But for high net worth people, it's actually a pretty powerful retirement tool. The HSA offers what's known as a triple tax advantage. It means that there's 3 ways that this account is tax advantage. The first way is that the contributions you make to it are tax deductible. The second thing is that Any of the investments you have held in the HSA will grow tax-free. And third, when you withdraw an HSA for qualifying expenses, you won't get taxed on those withdrawals. So it like combines the traditional IRA and the Roth IRA into one account. This triple tax advantage makes the HSA a top priority. For people with high cash flow, beyond its normal use, the HSA can work like a health IRA. After you turn 65, you can take out the money for any purpose without any penalty. Though if it's not for medical expense, you'll pay normal income tax on it, just like a traditional IRA. But what's really cool is that unlike 401ks and traditional IRAs, HSAs have no required minimum distributions. These are also called RMDs. So RMDs are distributions the IRS makes you take when you retire after a certain age, so the IRS can collect taxes on your traditional accounts. The ability to contribute to an HSA is tied to being enrolled in a high deductible plan, which is another outside factor that can really impact a high earner's tax planning potential. So HSA plans can't have it, not everybody can get it. You have to have a certain health insurance plan in order to be able to open an HSA. And it has to be a high deductible plan, but also be sure that not all high deductible plans are HSA qualifying. So make sure you check with whoever your insurance broker is or your employer to make sure that if you do want to do this strategy, you have a health insurance plan that is HSA qualifying. A lot of people think that tax efficiency is about what you invest in, but a more sophisticated approach shows that it's all about comprehensive strategy. The goal is to minimize tax drag, which is the annual erosion of your returns from capital gains and dividends, by strategically putting your assets in the most appropriate accounts. Have you guys heard of ETFs? Well, if not, let's talk about it right now. From the IRS's point of view, the exchange traded funds, or ETFs, and traditional mutual funds are subject to capital gains and dividends tax. But their operational structures create a huge difference in tax efficiency. So if you heard of mutual funds, the problem with mutual funds is that they're actively managed, and there's a lot of buying and selling of the shares within the mutual funds throughout the year. Now, the buying and selling of these shares creates taxable events, right? That means the fund manager, if they want to like buy more shares and then sell some off, the selling of it creates a taxable event, which then gets passed on to you, the taxpayer, the holder of the mutual funds. And that's why mutual funds have gone less popular throughout the years, because of how it's actively managed. Some fund managers may claim that mutual funds can beat the market, but overall, if you factor in capital gains tax, short term and long term, you might not be beating the market. If you're experiencing this tax drag on this actively managed fund. That's why ETFs, on the other hand, operate very differently. When you sell an ETF, it's a transaction on the open market. It doesn't require a fund manager to sell any of the underlying assets. To handle big money going in and out, the ETF manager creates creation units, large baskets of assets that are exchanged with institutional investors. This process generally avoids taxable events for you, making it rare for an index-based ETF to pay out capital gains. The structural difference is what makes ETFs a more tax-efficient choice than traditional mutual funds for your taxable accounts. So if you think about it, if you have an ETF, you contribute the same amount of money to an ETF as a mutual fund. Every year, let's say your mutual fund reports like a small bit of capital gains, and every year you have to pay tax on the capital gains. That means each year you're losing a little bit of money to taxes. Whereas with an ETF, it's not actively managed. It's not having income tax related events every year, so that your money keeps growing without having to report all those capital gains. Next thing I want to talk about are municipal bonds, or muni bonds. Muni bonds are debt instruments that states, cities, and counties issue to fund public projects. The big reason millionaires love these is that the interest they pay is generally exempt from federal income tax. And even better, if you buy bonds from a municipality in your home states, the interest may also be exempt from state and local taxes also. Because of these significant tax benefits, the interest rates on muni bonds are typically lower than those on taxable fixed income securities like corporate bonds with a similar credit rating. The decision to invest in muni bonds often comes down to a tax equivalent yield calculation, where the lower interest rate is more than made up by the tax savings, making them a valuable tool for high earning individuals looking to generate tax-free income. All right, let's talk about donations to charity and strategic charitable giving. Have you all heard of a donor advised fund? This is, if not, let me talk about that right now. So a donor advised fund, think of it like a charitable savings account that you set up at a public nonprofit charity. The process is super simple. You contribute cash, securities, or other assets to the fund, and you get to claim the immediate tax deduction. That money is then invested and grows tax-free until you're ready to recommend a grant to an eligible public charity. The magic really happens when you donate a long-term appreciated asset, like a stock you've held for more than a year. And by doing this, you get two huge tax benefits. You get an immediate income tax deduction for the full value of the assets, up to 30% of your AGI. And you completely avoid the capital gains tax you would have had to pay if you sold the stock yourself first and then donated the cash. For a high earner, a DAF is also great for bunching your charitable contributions. The strategy involves putting 2 or more years worth of giving into a single year to get above the standard deduction threshold and maximize your tax benefit. You get the tax deduction up front while having the flexibility to recommend grants to charities over time. Now, what this means is if you don't know what charity you want to donate to, but you do want to donate to charity, what this Donors Advised Fund gives you the opportunity to do is you contribute money to this DAF, kind of like contributing to an IRA or something. You contribute money to this DAF, and you get the deduction right away, and you can decide later who you want to donate the money to. But the benefit is you get the deduction right away. Now let's talk about qualified charitable distributions from your IRA. Now, if you're a bit older, say 70 and a half or more, there's a different tool called the Qualified Charitable Distribution, or QCD. A QCD is a direct transfer of funds up to $108,000 from your traditional IRA to a qualified public charity. This strategy is only for IRA owners who are 70 and a half or older. Now, the main benefit of a QCD is that the money you donate is not counted as part of your taxable income. This is especially valuable for people who are required to take required minimum distributions. Remember those RMDs I talked about? This is useful because these donations, these distributions to charities will count towards those RMDs that you're required to take. The key difference between a DAF and a QCD is very important. So a DAF is a tool for a younger, high-income earner to manage taxable income by getting a big deduction up front with appreciated assets. A QCD, on the other hand, is a tool for a retiree to manage RMDs and lower their taxable income in retirement. This difference is highlighted by a critical limitation. You can't make a QCD to a DAF sponsor, a private foundation, or a supporting organization. These two tools, though both for charity, serve different purposes at different life stages. So you need to know which one is right for you. All right, let's talk about tax loss harvesting. When the market takes a hit, most people get nervous, but savvy investors see a golden opportunity. It's called tax loss harvesting. This is a strategy of selling securities at a loss to create a capital loss, which then you can use to offset any taxable capital gains from other investments. If your total capital losses are more than your capital gains in a given year, you can use up to $3,000 of the remaining loss to offset any of your ordinary income. Any extra losses will be carried forward indefinitely to future tax years. Now, the real value of the strategy isn't in the sale itself, but in what you do next. A sophisticated investor's goal is to set the tax benefit while keeping their portfolio's desired market exposure. And this is where the strategy becomes both an art and a science. And it also requires a deep understanding of the wash sale rule. Now, what's the wash sale rule? The wash sale rule is the government's way of preventing you from getting a tax break while you're basically keeping the same investment position. The rule says you can't claim a loss if you sell a security and then buy a substantially identical one within a 61-day window, 31 days before or after the sale date. The term substantially identical is a key nuance because the IRS doesn't give a rigid definition. It just says, look at the facts and circumstances. However, tax experts have some clear examples. Okay, here's an okay strategy. You sell an S&P 500 ETF from one provider, like Spider, at a loss, and then immediately buy a different S&P 500 ETF from a different provider, like Vanguard. These are generally not considered substantially identical because they have different managers, might use different methods to replicate the index, and might have different fees, so you preserve the tax benefit. Now, one bad example of this is, let's say you have Berkshire Hathaway Class A shares at a loss, and you sell those, okay? You immediately buy Berkshire Hathaway Class B shares. Even though the ticker symbols are different, these two securities are considered substantially identical because they represent the exact same portfolio and only differ in price and voting rights. It's super important to know that the wash sale rule applies across all accounts that you control, including taxable brokerage accounts and deferred accounts like IRAs and 401ks. For a high net worth individual with multiple investment accounts, keeping meticulous records and understanding the rule are absolutely essential to avoid accidentally triggering a wash sale and having your tax deduction denied. All right, last thing I'm talking about are alternative investments. That's a lot of wealthy people use. These investments have a ton of tax benefits. These are things beyond your typical stocks and bonds. They can sound a little complicated. They sometimes sound a little shady if you haven't heard of them before. But with a smart approach, you can see that their tax benefits are given. They're created through specialized knowledge and planning. So, the first type of alternative investment is actually in movies and film production. States all over the country offer various tax incentives to attract film and television production. These incentives are super valuable to a production company and can also be acquired by outside investors. The incentives come in different forms, including tax credits. This is the most common incentive that it can either be refundable or transferable or non-refundable. Another type of benefit are grants and rebates. These are direct payments from the state to the production company, usually as a percentage of what they spend in the state. As an individual investor, you can strategically invest in film and get these valuable tax credits. For example, in California, a production can be eligible for a base 35% tax credit on local spending and crew, with a total potential 10% bonus for filming outside of Los Angeles. Okay, so investment in film. You can't just find these anywhere. You need to know who to talk to or who to call in order to get into these investments. We have connections to those. If you're interested, you have to be a high earning individual, over $1 million a year. Let me know. Hit me up in the comments. I can get you connected. Now, another part of alternative type strategies are what's called a fee simple title transfer. Now, these used to be known as conservation easements. And now the IRS has kind of nerfed the conservation easements. So what we have now is something kind of similar, but they're called fee simple title transfers. Basically, what that is a donation of land that you own. And the donation, you donate to a land trust, and it counts as a charitable tax contribution, like a charity contribution. The difference is the value of the deduction is actually equal to the value of the land as if it were developed for mining or whatever it is, whatever the best use of development is for the land. That means the value of the land, if it were appraised for like developing a rock quarry on it, will be a lot more valuable than just the value of the land undeveloped, right? So if you have land that you want to preserve and you donate the land with the appraisal of a development, you can get a pretty big multiple on the value of your land. I mean, just something to think about, right? So if you don't have connections for these types of investments, we do as well. So hit me up. If you're a high earning individual, these two things can be a huge tax savings for you. I'm talking 5-6 figures in tax savings. All right. There's other things too, like solar, syndicated solar credits, opportunity zones, 1031 exchanges. All these things. I'll throw up a little chart here of what things are doable, but you'll just have to look more into these, do your own research. I've done a lot of my own, and I partake in some of these myself. But these could be, like, aside from all those other things that we talked about in this video, these are pretty powerful. For a millionaire, tax planning, as you can see, just isn't a one-time thing. It's a continuous, proactive process. The tax code is a dynamic ecosystem, and the people who succeed in building and preserving their wealth are the ones who aren't afraid to dive into its complexities. From unlocking hidden retirement accounts like the Mega Backdoor Roth and HSA, to strategically placing assets to minimize tax drag, to using charity as a powerful tax reduction tool. These strategies all work together to create a tax-efficient financial ecosystem. The core principle is to get a nuanced understanding of how things work. The success of a Mega Backdoor Roth is tied to your employer's benefit package. The effectiveness of QCD is limited by your age. The value of the film credit is determined by state law. And the power of tax loss harvesting lies in the disciplined investment that navigates the wash sale rule. The biggest takeaway here is this: the most valuable asset you can have isn't a stock or a piece of property. It's the knowledge and expertise to navigate this stuff. Working with a qualified team of tax and financial professionals is essential to creating a custom strategy that works for your unique financial situation, turning a high-stakes game of tax planning into a winning advantage.